Lenore, after today, things get very busy on the economic front. With all the data coming in this week, what's top of mind for you?
The Fed, definitely the Fed. I mean, the markets are pricing in a Fed that's not only going to cut, but thinking that this Fed is going to be highly supportive going forward. Remains to be seen whether or not that's going to be terribly accurate. And also with the Fed, what I really want to hear about, and this is one of the things that very few people have been talking about, is what's going on in this overnight repo condition. So the overnight, banks borrow and lend to each other all the time overnight, and that's the repo market. Now, what we've seen happen is it's completely frozen up. So the Fed had to step in because banks weren't lending to one another, even though they had plenty of excess reserves to be able to do that. Now, there's only two reasons a bank doesn't lend to someone. It's because there's a problem with their credit, or there's a problem with its collateral. So they've got all this money to lend to one another, but they're not doing it. And the Fed's been stepping in, and we've seen week after week where the amount that the Fed has to step in and provide is more and more, but we're not going to call this quantitative easing. So I'll be looking to see if they can give us any insight into that, because so far one of the other things that's worrying about it is no one really has a clear explanation. None of the experts are coming out with a clear explanation for exactly what's going on, and that always worries me.
So, Lenore, there's obviously a hotly contested now narrative about this, right? The Fed says, look, it's not QE, it's just providing a little bit of, grease to the wheels here, to your point. We know they've taken measures like this in the repo market before the great financial crisis, but look, this is a huge amount, and they're continuing to expand it, right? So what are we going to use, though, to test, though? How are we going to really measure this empirically, say a month from now or a week from now, and say, okay, it's done this and it has a negative effect XYZ, or it doesn't?
Well, what I'll be looking for is it going to be continuing to grow? Because so far, they started off and every time they've come out and said, no, don't worry, nothing to see here, the amount that they're having to step in and provide keeps going up. So what I'll be looking for is it continuing to go up. What I'd rather see is have it come down, because remember when this first came out, they said, oh, it's idiosyncratic, it's no big deal. It's because we had this conflagration of crazy events all at once, no problem, one-time event. Okay, well, it's been weeks now and it's still happening. What I'd like to see is it start to taper back, because if you're continually rolling night after night, you're having to keep borrowing, they're going to have to keep providing this excess liquidity. That's actually starting to turn into longer term lending, right? If you're lending overnight again and again and again, now we're starting to get to a long term. And what that's telling me is that maybe there's really some problems with the underlying collateral in the system. And if we look into the broader market, there are reasons to be concerned. Right now, corporate balance sheets are in the worst shape they've ever been in. We've got roughly 16% of companies in the United States are effectively zombie companies. And what that means is that the cash flow from operations just isn't sufficient to cover the interest expense alone. So the only way that they can kind of keep going is to keep borrowing more and more. Now that's compared to, so it's 16% now, that's compared to about 2% back in the 1980s.
Lenore, when we look at this nature of the bond market still with very low yields, but we're out of the inverted yield curve, the stock market at highs, thinking about the two as, quote unquote, telling different stories. I'm wondering, though, if we see the market at highs yet again, the bond market starting to uninvert itself, is it possible here that our bond market signals maybe were a little bit too dark and pessimistic? Is it possible that we've seen the bottom in yields? I mean, what are we going to be looking for to see if maybe expectations for things getting rough are still not being lived up to? Even with the data getting a little rough this past month, it's like the bond market just got way ahead of itself. So how do we know what sort of signal to heed?
Well, if we're looking at the equity markets, let's keep in mind what's really pushing those markets up. Volume, not very good. If you look at the level of retail investment going into equity mutual funds and ETFs relative to what's going into cash and to bonds, it's at a level that we haven't seen since 2008. Last week's Barron's semi-annual poll of the sharp money manager guys, they're more bearish than they've been in years.
Right.
So
many would say that's a bullish thing.
The indices, well, yes, but there's reasons to be worried when I look at, we're now going into the third quarter of contracting earnings, right? So third quarter of contracting earnings, we've got the Fed having to cut rates again. We have a federal deficit that's about 5%, nearly 5% of GDP. And we've seen that deficit increasing significantly year after year after year in a degree that we haven't seen since the 80s, when unemployment was double digits and we were in a big recession. So I look around and I'm like, well, where's the extra juice going to come from? Where's the enthusiasm going to come? You've got corporations that are loaded up to the hilt on debt. You've got a government that doesn't have a whole lot more juice it can squeeze out as far as more government spending, given we already have really high deficits. And you've got a Fed that's like, oh darn, we got to cut rates. And the ECB doing, the European Central Bank doing the same thing. I look around like, okay, where is this enthusiasm going to come from? And all of this is happening when you have unemployment so low. So where is that thing that's going to really kick off and give me some optimism about the next coming quarters? And if you just look at last week, Thursday and Friday, out of all the companies that provided guidance, those that guided downward versus giving more optimistic guidance were pacing 2-to-1 more negative than positive.
Okay, so on earnings,
kind of sound like a downy.
Hey,
I sound like a downer today, don't I?
We've got a whole list of bulls that'll come on and make the bull case. Lenore, what I'm curious about is if this is going to manifest itself, though, in ugly numbers for the economy this week, if earnings have to get worse, because even with some of the nominally negative things that you're describing, right? Companies like Caterpillar and 3M, no disputing that there's no real positive guidance coming from them. But yet the stocks are like they found some kind of a floor, even with some of the negative numbers. The economic numbers, again, even as they've softened up and our surprises turned south this past month, bond market's now going the other way. So are we seeing maybe that the actions by the Fed or something did indeed have some preventative mechanism?
Well, I think what we've got, what's really popping the equity market up is a couple of things. One, you've got the IPO market is really taking a dive. So you've got less new shares coming on board. You were talking about Fitbit, right, being potentially acquired by Google. And we heard earlier today about Tiffany, that LVMH is looking at them. What we're seeing is a surge in M&A activity, which is also helping the market. And that's typically something you see in the later stages. And let's not forget share buybacks, because like I said, those retail investors, there's not much there. If you look at the level of share buybacks since the financial crisis, they're at about $5 trillion in share buybacks. You've got only about 1/9 of that has been actual investors going into the marketplace. So this really has been a story of share buybacks, which when you think about earnings, EPS is not the same as operating profits, right? Those EPS numbers are because they've got such a low number of shares outstanding because of all those share buybacks.